You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Education Wednesday. That means it's time to kick things off with your premier educational go-to source. Yes, it is time for Options Bootcamp. My name is Mark Longo from theoptionsinsider.com. Don't forget the at the start of it. You'll miss out on all that good stuff, the earnings move, season results and trades reports, the most actives, all the other fun stuff. Obviously, links to all of our shows and a whole bunch more, including potentially maybe a little fun book club list. We'll get to that in a little bit. And of course, if you guys want to go above and beyond, join the show live, Q&A sessions, everything else that we do here on the network. Options Oddities for some fun live trading and also some look backs at crazy, unusual activity. You know where to go, theoptionsinsider.com/secret club. Don't tell anybody, though. It's a secret. Just between you and me, okay? And, of course, however you listen live after the fact, hit us up. Questions, comments, insights, pearls of wisdom. We do love to hear from all of you folks out there. Man, you guys, especially for this show, I don't know what it is about boot camp that just opens the floodgates. You folks are not reticent about sending in your questions, your comments, your thoughts, and your discussion topics. We appreciate them all. Keep them coming. And joining me to help sift through the maelstrom of madness that is your email and your tweets and your questions and everything else, none other than the black-hatted one himself, Mr. Dan Passarelli, from what the cool kids call what I call market taker mentoring. Mr. P, welcome back to the program, sir. How are things in the land of
Hey, how's it going? How's it going with yourself? How's it going, man?
Things are good. COVID is spreading wild. Everyone I know seems like they've got, except for my close family, thankfully. We're lucky, but just about everybody else seems to be coming down with the old Omicron these days. So finger crossed we're good, but we did load up on about a gross of tests recently. So good times are to be had by all. But rather than talk about that nonsense, let's keep on rolling. I think all the cool kids want to know, Mr. Dan, what's your rating?
I'm actually working on a couple other little projects, doing some testing on one of our momentum trade systems and, just creating new and better ways to trade for our traders.
Speaking of better ways to trade, you guys have all sorts of questions all about that. So let's get to it. It is time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Let's dive into your questions, your feedback. Sometimes your feedback comes in the form of feedback on our polls, our questions of the week. Remember on our last show, listeners, we asked you, it was hot, it was fast and furious. Will VIX close above or below 20? All this madness, of course, with Omicron. So we pushed it out a week to try that one again. And man, you guys were split. You were dead split. About as close as it comes to a coin flip in these polls anyway. We had 48.7% for above 20 at the end of the day, 51.3% for below 20. And of course, that's where it ended up closing last Friday. 1871 is where VIX went out last week. So we thought we'd take that question this time and push it forward again, because it is a fascinating one given what we're dealing with right now. Some more protracted sell-offs in the market again. Vol starting to trickle up a little bit again. So we thought, let's push it out, not just this week this time. Let's go all the way through to the end of the year, which isn't as far away as it sounds. And say, hey, how are we going out the end of the year? Are we going out the year above 20 or below 20? Usually we make you guess a range. This time we're not even doing that. Just give us effectively elevated or not elevated from the vols, really what we're asking out here. I won't reveal the voting yet, but Mr. Dan, sir, what are your thoughts? Where are we going out at the end of this year? Are we going out above 20 or below 20, sir?
The end of this year, I'm going to say below 20.
Interesting. You're on the below 20 tip. Well, you are joining. This is funny. This is almost exactly the same numbers. You are joining 51.6% of our audience, Dan, who says below 20 and 48.4. But they are evenly split again, which maybe this goes to show that we're going to be hanging out right at the 20 strike again. Because that's pretty much what we did right up until the end of last week. So our audience is split again. This is the third time, I think, in a row now our audience has been split on this, which was what makes a market and also is kind of fascinating. What do you guys think? Get over there, add options. This one's going to expire in about a day or two. So the clock is ticking if you want to play along. Make your voice heard. Let's get into a whole bunch of your questions and feedback and concerns. Well, let's start with this one here. This kind of goes back to our episode from a couple of weeks ago. I told you, Dan, when we did the book club, that we're going to have lingering discussions about this for a while. This was an interesting one. This came in from a Heron Verno, and if I'm butchering your name, I do apologize. They say, do you guys have the recommended books listed anywhere? I wanted to check some of them out, but couldn't make a note of it since I was in the car. Having a list on the site would be fantastic, though, so you can update it as you find more good ones. That is a great idea, Mr. Heron Verno. So we are going to take your suggestion, and we are going to implement this over there at theoptionsinsider.com. Again, don't forget the. We'll make sure we put it out on Twitter and everywhere else so you guys can see it as well. But if you listen into the show, you want to go over there. Maybe we'll try to link it on the show page as well so you guys can find it. And it'll be kind of what we talked about on the show that time. It'll be our guide for starter books, which was kind of the goal of it. Then we kind of evolved beyond it with your feedback and everything. And literally everyone we've talked to, even myself and Dan, I put this question out to others since then. Everyone comes back to, if you are going to just read one, it is still Natenberg. It is still the Bible. And then beyond that is a pick'em. There's a who's who of out there. You got your McMillans, you got your Hulls, you got everything else out there under the sun. We will make a list of all these. We'll put them up there so you guys can click on them. We can also update it from time to time. We can add sections, specific sections. You want to talk about volatility. Then maybe you start with Russells, then you graduate to Ewan Sinclair's for a little bit more of a quantitative approach. Maybe you want to talk about income, trading, or other things like that. It's some more fun type approaches to it. There's a lot of different ways we can crack that one. So interesting that we will put this up. We will tweet it out. We will put it on the website so you guys can find it and click through to all the books, obviously. And then we will keep updating it over time. Does that sound like a plan, Dan? You like that idea? Have an updated running book club list for the show here?
Yeah, I think that's a really great idea, man. Keep moving forward.
And then at the bottom, we'll have to have a section for all 47 of your tomes, sir.
Yeah, that's a very good idea.
I don't know if we can fit them all on one book club list. Might need about 5 for Dan's lengthy oeuvre now. The Passarelli options oeuvre is a list unto itself. All right, let's keep on rolling here. Let's actually go out to the live. You guys, if you're in the live, we like all you folks. We like you live folks too. And you guys get bumped up here to the top here. Just like, I do love this handle, Age of Delaquarius. That's one of my favorite handles we have going in there. He says, question I've been thinking about. I butchered it for you. There, let's try that again. Question I've been thinking about. I added the wrong emphasis on the wrong syllable there. If we ever find ourselves in an environment with quickly rising interest rates, would the expectation of higher rates in the future push the price of LEAPS up? LEAPS, obviously, listeners, are long-term equity anticipation securities, kind of the longer-term options you see out there, usually a year or more. He says, if so, would that affect LEAPS with an expensive underlying more? We didn't have 4-figure stocks back in the 70s and 80s high interest rate time. Yeah, you're right. But they would have split multiple times in the round lot purchase era. So interesting stuff. Dan, we're kind of in that mode again where everyone's kind of got rates on the brain. Our friends over there at the Fed have been meeting this week. So a lot of people talking about Fed, looking at the Fed Watch tool over there. By the way, if you're not familiar with that, listeners, cmegroup.com/FedWatch, a great way to see what the market is actually forget what the talking heads are saying and analyzing the old days of analyzing Greenspan's briefcase. Is it thick? Is it not? Forget about all that nonsense, all that noise. CMEgroup.com/FedWatch. It's a free tool. It tells you exactly what the market's pricing in. And that probability is pretty spot on usually out there. But Dan, a good question. Let's start with the basics of this. We find ourselves in a quickly rising interest rate environment. Would the expectation of higher rates push up the price of LEAPS? And then as an addendum, would it impact the LEAPS on the more expensive underlyings more, sir?
Yeah, great question. Who knows? We could end up finding ourselves in this exact situation, right? So LEAPS are affected by interest rates much more than short-term options because, well, I mean, there's just more interest involved because there's more time involved. But as far as pushing the price of LEAPS up, it depends if it's a call or a put. Because if you think about an option as a substitute for buying the stock, if you think of a call option as a substitute for buying the stock, if you buy a stock, you're tying up a lot of capital. Therefore, there is an interest rate component to it. Even if you have the cash sitting around, then it's cash that can't be earning interest. And so there's an interest benefit to owning calls because you're tying up less cash. So the higher the interest rate goes, the higher the price of the calls goes. But for puts, it's going to be just the opposite because being long a put is a substitute for being short a stock. And professionals who are short stock, they get paid a short stock rebate. They collect interest on that money that they receive when they short the stock. And so it's going to affect puts differently from calls, just the opposite, as a matter of fact. And that said, while time is one of the components, right, just the amount of cash that the interest rate is being calculated on also matters. So, right, you're spot on here, age of Del Aquarius. The higher the price of the underlying, then also the more meaty the options, and there's just more interest paid on that. So, right, the higher the price of the underlying, the more row is going to end up mattering.
A lot more cost to carry over time on these 1,000+ handle names out there. That is a good point. We didn't really see a lot of 1,000 outside of like Berkshire Hathaway, maybe. I'm not sure if even that was that high back then. But outside of that name, there weren't a lot of 1,000+ handle underlyings back in the high inflation days the last time. So it is an interesting scenario to consider and a good one. I'm sure a lot of people have questions along these same lines there, Age. So good time to get those rates questions in. If you guys are curious about the impact of rates on options pricing, and again, I've joked many times here on the show, it's kind of indicative of where we are in the marketplace and the economy when people start asking questions about what effectively is Rho, which is the impact of rates on the price of an options. Usually that's the forgotten stepchild. It's the fifth Greek. I know, Dan, do you even have a chapter on Rho in your Greeks book, or is it like a mini appendix at the end?
No, I do. I have a full chapter on Rho and then a couple more just on interest rates and like put call parity, reversals and conversions, which all sort of ties into that.
So there you go. You can check out Dan's book. You can also always check out the archives of this show. We've done a lot of episodes over the years on the impact of rates on options, but an interesting flavor to it with the high-priced underlyings, which we are seeing more of these days. Your Amazons, your Teslas, and all that fun out there, even if they are a little bit cheaper right now than they were, let's say, a few sessions ago. All right, let's go back out. We got good handles this week. Next up, we got Straight Right. He says, when skew gets high and puts are expensive in SPY, which you could probably argue is close to right now, maybe not quite as high now as it has been, but they are pretty lofty out there. All right, he continues, what are some steps you take to minimize the cost of outright hedging? Is it simply a matter of adding a put spread to your put, or perhaps a put spread with a covered call? The problem with the call is that you have to sell almost at the money to cover the put, which makes it worthless to hold SPY. Thanks for your insight on this matter. Yeah, you've discovered the quandary a lot of people are in right now, Straight, which is, you're right, the typical use cases of it. The collar is one of the first starting points people go to. I've said it many times on our advisor show that is the holy grail for a lot of asset managers out there, right? Because they're managing a lot of long equity positions. They want to hedge, and the collar is a great way for them to do that. But as you've discovered, these days, the calls are not getting much juice at all. I recommend you go to our cmegroup.com/TWIFO, TWIFO, or /TWIO. Both of those will work. And then pull up whatever index you want, NASDAQ, S&P, doesn't matter, Russell 2000. You will see exactly how expensive these puts are compared to the at-the-money. It's going to be somewhere in the 20+% range premium over the at-the-money vol out there right now that you're paying for your, let's say, most of these measure the 25 delta put, so it's going to be somewhere in that range. But any of those puts you're looking at are going to be somewhere in that premium range. So you're right. It is challenging. And selling the call is going to be the opposite. It's going to be a discount of 15, maybe 20% to the calls as well. So you're getting nothing for the call. So the collar, you kind of have to question that now as to whether it's worth doing that because you're limiting all your upside for very little gain. So you're right. It is kind of right now, the put spread is your friend out there right now because you are selling a farther out of the money put. You're taking advantage of that very jacked put skew out there right now. And the put spread is your friend. Now, people do get sometimes into trouble with this, Straight and everybody else. They see that and they say, well, if I like this as a spread, maybe I'll turn it into a ratio. Maybe if I like it one by one, maybe 1 by 2. Look, now this put's free. And 1 by 3, wow, I'm great. So you have to be a little careful with that. If you are going to do ratios, then let's maybe keep it to 1 by 2 and let's probably do a fly, right? Let's keep things risk mitigated at the end of the day. But you're right. Right now, the put spread is your friend. There are some alternative ways to go about paying for your protection in interesting ways. I encourage you to check out the episode I just did with Matt from Orats on the advisor's option program. We talked about a whole episode just about this. And what's great about Matt's data is he has a great back test machine to go back and test the efficacy of all these things in a variety of scenarios. And we talked about all these different ways and how they work and what they don't. We kind of came to the same conclusion that the collar, not quite worth it right now. The put spread is your friend, but also some interesting nuggets we threw in there that are a little bit more advanced, but he's been exploring and back testing really, really crappy longer term, like let's say a year or so out, very low delta puts, sub 10 delta puts, like somewhere in the 5 to 10 delta range. Garbage puts, quite frankly. And he's been back testing those, and they actually work surprisingly well, he's discovered, in these shocks we've been getting lately. Let's say the Omicron sell-off down 2%. So he's buying these things. They're longer term, so they're not going to be free. But they're going to be cheaper than buying let's say a 5% out of the money put with, a month or two to go. You're not getting a lot of delta for that, but there is a lot of vega in those far out of the money puts. And you'd be surprised how much that tail can swing in these crazy environments. So that's, again, a little bit more of an advanced strategy to look at. You have to understand what you're doing. And also, he liked selling some nearer dated crappy garbage puts against that. Now you have a bit of a time spread. It's a little bit more savvy of a position to manage, but that actually he's found has worked pretty well in this environment. So that's something, if that doesn't intimidate you, if you're intrigued by that, I check out that episode where we go into all the data about it and kind of the efficacy of it. Dan, what are your thoughts here for Straight Right? He's got the question everyone has right now, which is, how do I go about this? Collars are useless. What else can I do? And then B, what are your thoughts on that kind of garbage sub 10 delta a year or so out, kind of crappy throwaway puts that actually could have some value in this environment?
Well, I mean, a couple thoughts on this. One is, I'm not ready just to say, no, collars are stupid, don't do them. Just because you can't have a zero cost collar doesn't mean it's bad. You can still sell an out of the money call with enough room for the spiders to run. And it's not going to offset the entire cost of the put, but if it makes it a lot cheaper, then that's okay. That's fine. And put spreads have their place as well. The only bad thing there is if there's a situation where the market crashes 20%, which happens, right? It didn't fall 26% a year and a half ago, right? You're not going to capture all of that. But those are more black swan events. And some people even do a combination of those. Sell the call to offset part of the cost of the put, and then sell a much lower strike put to further offset the cost of the put. And then also, just going out really far, like you said, with a really long-term option that's way out of the money could be an okay idea too. It sort of depends on the exact objectives and the exact sort of thing that you want to achieve from having a hedge. It's not just like to hedge or not to hedge, but like what risk are you looking to protect yourself from specifically?
I should, a couple of caveats. First off, we recommend, I've never been a zero cost collar guy. So that's the way you're going. It's definitely challenging right now. But the modified collar, which we've discussed many times, I'm more of a fan of. You're pushing that put out roughly in the 3 to 6 month time frame, and you're selling nearer dated premium against it. So over time, you're not getting a lot of juice for that collar, but it's very near dated. It's going to go away pretty quickly. It's not going to really clip your upside too much unless you're in that very short 1 week time frame. Unless the market melts up, you should be pretty good. So over time, you should get some more aggregate value out of that. And also, if you look at some of the individual names out there, collars can be a little bit more friendly out there because the call spread, as we talked about many times, the call wing is getting bid to high heaven in those. So collars are more attractive in single names right now than they are in the big indices. They were pretty attractive in names like BIDO as well, where all the bid was to the upside. A little bit less so now as Bitcoin and others have sold off and the near-dated puts have gotten a bit of a bid. In fact, check out our recent episode of the Crypto Rundown. I had a great guest from Genesis Volatility there where he was talking about how the nearer-dated put skew in Bitcoin options now is actually getting pretty bid up. You have to go pretty far out, like 6 months or so, to get a little bit more reasonable collar-type setup out there. If you're intrigued by skew and how to pay for these things in a variety of underlyings, check out those 2 shows. Yeah, interesting stuff. Obviously, we can explore a lot of ways. And we have done this in the past on this show as well. Go check out our archives for ways to pay for puts. We've talked about this many times in the past. All right, let's go on. Another one people have a lot on their brain these days. Well, before we get to that, let's go back out to the live. Let's go to Luigi, my boy Luigi. He says, do you or Dan think the market has priced in the recent decision with regards to the Fed tapering? Or should I take the stance the lobster does and not pay attention to the noise? Well, it's kind of hard to argue against that latter one right now because there is a lot of noise out there. And how long has the Fed been playing the same tune that inflation is transitory, pay no attention to the man behind the curtain, this is all going to go away, when I think we all know that just can't be the case? If you're paying someone 20% more now to do the same job, you can't just take that away from them when times get better. That's gas to stay. So a lot of these costs we're dealing with now are going to be around for a while. That said, Mr. Dan, Luigi wants to know, do you think the market has priced in the recent decision with regard to the Fed tapering, sir?
Well, you mean the one that's going to happen in 4 minutes? Pretty
right? Much, yes.
Because there hasn't been any other decision except what happened at the last meeting, which was not really much of a decision. So I think it's the market's job to price in all the available news, and it does somewhat of a good job with that. Although, to be fair, the market's probably not really full form efficient. There is definitely a lot of noise in there, but I think the market does its best. Once we hear what Mr. Powell has to say today, then we'll have some more information, and that information will get somewhat priced in based on people's thoughts of what that information is going to do. I mean, it's more like, I feel like it's more a good conversation to sit and have a beer and philosophize about, or maybe a scotch if we're philosophizing.
Yes, scotch flows or a nice wine. Good for philosophers. Aristotle, big fan of wine. But yeah, it is interesting. The thing that drives me crazy about all this Fed noise, and we won't spend too much time on this, but it's not so much what Powell and the chairman says. It's when all the Fed governors then go out and do the rounds and they say all their own nonsense. That drives me crazy. Fed should speak with one voice, and it should be Powell's. And everyone else, they have their chance in the minutes, and then you shut the hell up. We don't need many different voices muddying the waters. That's kind of what causes a lot of this noise, is when they go on CNBC or make a speech somewhere and say, well, actually, I think this. And it's like, well, nobody cares. Shut your mouth, speak with one voice, talk in the minutes. Everyone can read the minutes. They could read your viewpoint if they are so inclined. But other than that, that's what drives me crazy about the Fed. And that's what keeps this, this noise lingering well beyond perhaps when it should be. But don't get me started on the Fed. A lot we can debate on. Maybe we'll have a whole Fed show one day on the network. That'll be scintillating radio. Let's get on out here to this is a handle, LLTT $**. Don't ask me to pronounce that. That's not even elite speak. I don't know what that is. He says, I get that I have leverage when I buy call options, and that when my call options expire, I have to buy the stock. But can I then buy the stock on margin afterward? Or do I have to pay the full amount for the stock? Well, no, LLTT $asterisk. You're just buying stock after. Once you exercise your options, you're buying a stock like pretty much any other transaction. What your broker will usually do is give you a few days for that transaction to settle and allow you to, if you don't have the capital in your account, to deposit the required capital in your account. So some people like to view that as, even if they have no intention of actually buying the stock, they used to view that as you get a few days of free float. You get a few days swing at the bat of a stock. If it rallies, you get that appreciation before they close it out of your account because you're not going to buy it for you. Or vice versa, it's a risk. If it sells off, you lose some money there as well. But some people used to like that aspect. It was a little bit of a extra roll of the dice at the end of that option's lifespan. But what you're doing there is effectively just a stock purchase transaction. So it's up to your broker and your account type what types of margin you have, but you should have available to you at the very least that basic 50% margin. So yeah, it's not because you're exercising an option doesn't mean you have to have some different rules where you have to pony up the full cost for that stock. You can still put up the margin there. Anything to add on that one? Relatively straightforward, Mr. Dan.
I'll just try and maybe summarize a little bit. Well, I mean, first of all, one caveat is that your broker can set whatever margin requirements and policies that they want, as long as it's within, the OCC's guidelines, and all the powers that be's guidelines. But yeah, if you are going to exercise or let it be automatically exercised 100 strike call, that's $10,000 worth of stock that you're going to be buying. And so if you only have $6,000 in your account, probably your broker's going to still buy that for you, but it's going to be on margin, presuming that you have the appropriate paperwork or whatever it is your broker requires you to do. If you only have $1,000 in your account, then you're going to get a phone call.
They'll say, pony up, the dreaded call from the broker. We got another chime in from the live here. Age of Del Aquarius, going back to the Fed things. I'm still on team transitory. Wage push inflation on some low-paying jobs isn't enough to push inflation higher long term. Well, let's hope you're right, Age. I like your optimism there. I like that the fact that maybe we're paying some guys $20 an hour and gals to say, do you want fries with that, is not going to translate into the long term. I do hope you are correct, sir. Just the diehard cynic in me says otherwise. Let's do a couple more here because you guys are having fun and we like answering your questions too. It's fun. All right, let's go to Mr. Or maybe just MR. Saying, when do you prefer to leg out of a butterfly versus taking it off as a complete unit? So this is, again, butterflies have been kind of the topic du jour these days, Dan. It's like every show we do, people have questions on butterflies. I think we've discussed this exact kind of thing before. I think in the past you've said that you favor taking it off as a unit, but I think we all know that isn't usually or always possible, Mr. Dan.
Yeah, no, it's not always possible. I mean, I tend more to do more iron condors than butterflies. I just like that level of forgiveness. But yeah, if you have on a butter, I don't know. Most of the time, I like to take them off on their own because because whichever side is going to be a winner, the other side is going to be a loser. And so if you're taking off the losing side to close it, then why are you leaving the winning side on unless there's still a lot of meat on the bones? Or if you're taking off the winning side to lock that in, why are you leaving the losing side on? So I don't know. To me, I just feel like when possible, it makes the most sense to do it as a unit.
That's, I think, the goal for every butterfly trader is to try to do it as a unit. I think most people realize very quickly it's not a viable option unless you go right to your short strike and you sit there nicely and just all the roads to zero. It very rarely, I'll give you a good example really quickly here, Mr. I had a put butterfly on in UVXY a couple of weeks ago when vol was starting to erode, then it rallied again. And so what happened was I think the short strike was somewhere around the 17 half handle, somewhere in that region. And the long was somewhere around, I think 19 half or 20, somewhere in that range. And UVXY was hovering around in the low 20s, then it had popped up. What happened, though, is it had languished in the high teens for a while, long enough, close to my short stripe enough. That strike had really eroded down to not much. And I put the butterfly on for very little as well. The puts were nicely bid out there. So it was an attractive opportunity. So it got to a point where I looked at it and said, these short puts are only trading for like 12 cents, 13 cents. I probably should take these off. And I still had a decent amount of juice, somewhere around 60 or 70 cents around that 19 or 20 put. So there was still a lot. I still had enough premium that I could have closed it out for a winner already. Not much, 20 cents, 10, 20 cents, but a winner. But I thought, this has decayed so much. It's given me a nice swing at the back. I still had about a week left in it. And one of the things, I got busy. I was doing shows for you folks. I said, I'm going to take these off later today. I didn't get around to it. Of course, UVXY imploded, vol imploded. And the next thing I knew, those puts were trading about $1.25. And I was heavily lamenting the fact that I didn't take them off for about 12 or 13 cents. So that would have turned that into a home run. I would have been just naked long a bunch of, I think, 20 puts in UVXY at the time. So it would have been a great one. So that's the time when sometimes you get afforded an opportunity to take them off piecemeal. It's not my desired outcome with the fly. A desired outcome is you hit your strike, you bang, you take it off for a huge profit as a unit, you move on to the next time. But people who trade flies know eventually you're going to have to start legging out of things as, into verticals or other things like that. So it's kind of the nature of the beast. Flies are a lot of moving parts, and very rarely do they all line up. All right, let's get out of here on this one, Dan. Let's go to this one from Rick. AAA. Maybe he works for AAA. Maybe he'll come tow your car. Rick says, seems like all the best options brokers have been acquired. Have you heard much about new folks entering the game? Dan, what are your thoughts on new options brokers entering the game, sir?
I think if there is somebody who's deciding to start an options brokering firm right now, he needs to let me know where he's getting his stash, because that would be a freaking crazy idea. I think that what's going on with crypto and the potential for smart contracts and just all the stuff that can be built on the Ethereum blockchain and Solana and Cardano, options brokers, they're scrambling to come up with a brand new business model, because because otherwise they're going to get put out of business. So it's going to be an interesting time for the traditional brokerage model going forward.
Dan, getting a little dire. Options brokers going to go out of business. Wow. On the heels of like the busiest year ever in the history of options, sir. So you're not joining me on my options panel coming up next month. You'll scale everybody in the place.
Oh yeah, they ought to pay some of that cash out in dividends to the shareholders while they still have it.
Well, you make a good point there, Rick AAA. You're right. A lot of the original options brokers that kick things off, your Options Expresses, your Tosses, and others that were options centric, have since been acquired. You are correct. And a lot of other ones have been gobbled up since then. Trade King is now Ally, and all these other ones out there. There are some new players who have entered the game. Gatsby is one that leaps to mind. They're options centric. Getting a little bit of traction out there. I'm not sure how much, but again, there's so much options volume out there now that rising tide lifts all boats. We have seen other more mainstream brokers pivot into options like Robinhood with less than stellar results but a lot of the bigger players are realizing that's where people want to be right now. So they are adding that, your Weebles and others didn't start off as traditional options brokers, but have since added all that as a result. So I guess you can call them new folks entering the game, as you put it here, because they have. So people launching straight up as options brokers, not as much anymore, but we are seeing people pivoting into that. And Dan's right. The crypto space throws a wrench into all of those works. Speaking of Dan, I like Luigi. Let's end on this one. He says, he's slamming you, Dan. He says, iron condors are iron butterflies for cowards. Yes, they are. You're right. Quoting our buddy Don, Mr. Don Schlesinger. That's his infamous quote from Volview. So there you go. Luigi calling you a coward, Dan. How do you respond?
Hey, you know what? I'll take it. I find the more cautious I am in trading, the better off I do.
So if other folks want to call you cowards or any other names, where should they go? What should they do, sir?
Head on over to markettaker.com. We love to hear from our listeners there. And so I would love to hear from you because, you're one of our listeners.
Markettaker.com, what the cool kids call And if you want more in your lives, don't worry. I've dragged Brian back kicking and screaming to do another live huddle. That's coming up around 3:30. I say around 3:30 because that's our planned start time, but sometimes he likes to do his live to tape episode first, so it could be more along 3:45. But get in there around 3:30, and I'll try to get him to kick off the huddle early. And we'll do a lot more of answering your questions, which you folks love and he loves to do. And it'll probably be the final huddle we do with him for this year because I think he's traveling after that. So get in there if you want to get at the huddle. I know a lot of folks like that. It'll be live 2 hours later today. If you're not part of the secret club yet, listeners, look at all the fun you're missing. TheOptionsInsider.com/secret club. It's just you and me, just a secret, just between you and me. Don't tell anybody else. And we got to get on out of here. Back again later today. OPR, of course, tomorrow, episode 2 of the option block, as well as TWIFO. We get our year-end check-in with the guy who runs pretty much everything options over there at CME. What the hell is lighting it up over there? We will find out. Trends, developments, new products, all that good stuff, and a whole bunch more. Friday Vol Views. Check that one out. If you're starting to learn about volatility, listening to a show like this, you want to go above and beyond. Got a great guest, Jem Carson, joining us again back on that one. And then, of course, end the week with your Secret Club folks and Options Oddities, where we kick it all off again next week, all the way through to another Education Wednesday, another episode of Options Bootcamp. We'll see you then.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.